You don't need to become a successful investor by picking individual stocks. There are lots of options out there that allow you to invest passively without the headache of any in-depth analysis or research.
It's overwhelming.
For example, you could simply invest via index funds or an investment trust. But if you plan on picking individual stocks to make up part or even all of your investment portfolio, then it's really important to familiarise yourself with a few key metrics which I'll be covering in this Investing Explained series on my channel. Have you ever scrolled through the stats of a particular stock and stumbled upon the EPS or earnings per share and wondered, what's that? And how can this information actually help me? Well, that's the metric I'll be looking at in this video. Earnings per share is one great way that us as investors can assess the profitability of a stock that we're looking to buy. In fact, it's probably the most important measurement of a company's profitability. As a metric, it's used extensively and tends to be reported each quarter when a company releases its earning report. So let's take a look at the largest company by market cap in the world at the moment, Apple.
We go to our Steve Kovac. Steve, how do they look?
Yeah, John, you see shares going up 2.5%. It's a beat on the top and bottom lines for Apple.
Last month, the tech giant published its Q2 financial results, and in the first paragraph of its press release, they mentioned their quarterly earnings per share of $1.52. If you dig a bit deeper and take a look at Apple's financial statement for the quarter, you can also see earnings per share is featured here too. So you can see how vital this metric is when it comes to determining profitability of a company. Now, sifting through all this information for every single company that you might want to invest in is really long-winded, I'll admit, but the truth is you don't even need to look at a company website or their financial reports to work out the earnings per share. I'll show you how you can gather this data quite quickly and easily later on in the video. But what's the point of having this information in the first place, and how can we use it to our advantage when we're picking stocks? Fundamentally, the EPS metric shows us how much money a company is making or how much profit a business is generating on a per share basis over a given period. So with the Apple example, for every share you owned in their second quarter, you would be entitled to $1.52 of Apple's earnings if they suddenly decided to distribute their profits to shareholders. Perhaps more important than this, the earnings per share gives us some idea of how fast a company is growing. In an ideal world, we want to be putting our money into companies that have been steadily increasing their EPS each quarter, because this means their profits are growing at a decent rate as a ratio to each share. If a business has been consistently increasing their growth rate over time and there are more profits to go around per share, then this is usually a really good sign. It's quite simple to work out the earnings per share by dividing a company's net income over a year or fiscal quarter by the number of shares a company has outstanding. So if a company has a net income of £50 million and has an average of 25 million shares, the EPS of this company will be around £2. Looking back at Apple's financials then, you can clearly see how they've applied this by dividing the net income for the quarter by the number of shares to give a basic EPS figure of $1.53 and a diluted EPS of $1.52. Just to explain, basic shares are the number of common shares that are outstanding at the time of reporting, whereas diluted shares are the number of shares that could exist if every single one of the company's shares were converted to ordinary common shares. So things like employee stock options, convertible bonds, etc. So as the name kind of suggests, you're basically diluting the pool of publicly tradable shares with the diluted shares option. Because of this, the diluted EPS will always be lower than the basic EPS if the business is in profit, because the profits have to be split among more shares. Most of the time, you shouldn't need to calculate the EPS yourself or spend hours looking at earnings reports, because you can usually find the EPS for a company wherever you find your stock information. I'll link some useful resources in the description down below, but essentially you should be able to find this data quite easily without breaking out a calculator. For example, with Yahoo Finance, you can find the trailing 12-month EPS on the summary page of a particular stock, and even view the history of estimated and reported EPS figures over the lifetime of a company, which is really useful to identify trends. So as I mentioned earlier, looking at the EPS gives us a more accurate indication of a company's performance, rather than just looking at their earnings in isolation, although you definitely want to be considering both. Just looking at how much profit a company is generating doesn't really tell us much as shareholders, because our stake is limited to the shares we own rather than the company as a whole. So in reviewing the EPS, we get a much better idea of how the company is doing for us on an each individual share basis. What slice of the profit are our shares getting us? And is this increasing or decreasing over time? Also, just looking at profits or earnings in isolation to assess company performance doesn't always show any tinkering that might be going on internally. If a company is buying back its own stock in what's known as a stock buyback, for instance, which Apple does quite regularly,
They buy themselves. Apple's favorite thing to acquire is itself, shares of itself.
or if a company dilutes your interest by using shares for other means, you wouldn't really see this just by looking at an earnings figure. But you would certainly see it once you divided the profit by the number of shares that are outstanding. So the more shares a company buys back, the higher the EPS, which is good for us as investors. But the more shares a company spends in diluting by paying or incentivizing management staff with share options, the lower the EPS will go because the availability of outstanding shares has increased. Notice that the headline profit number doesn't change at all, so that's why it's important we look at both as part of our due diligence. Usually, when a company is profitable over a particular quarter, its EPS will be positive. If a company has lost money over a period of time, it will usually report a negative EPS. What you often see is a quarterly estimate of a company's earnings per share released before the actual figure is reported. The variance between an estimated and an actual EPS can have a significant impact on the short-term movement of the company's stock price, so it is a metric that we want to try and keep an eye on if possible. Although earnings per share can be a great way to assess profitability of a company, we need to remember that this number can fluctuate substantially because net income can either grow or decrease in any given period. But also the number of shares on the public market can increase if the company issues shares or decrease if management initiates a stock buyback. Not only that, the EPS can also be subject to manipulation by, shall we say, some interesting accounting methods. So we really need to protect our interests as investors by doing two things. First, by reviewing the EPS not only in isolation, but over multiple quarters or years to get an idea of general company trends. And secondly, by looking at metrics other than the EPS to gauge the performance of a company, as we wouldn't want to use it all by itself. There are companies out there that are reporting a positive EPS even though they're losing money and about to go bankrupt. Another metric you can use to examine a company's performance is the price to earnings ratio, or PE ratio. If you'd like to learn more about the PE ratio and how it can help you pick your next stock, then be sure to watch this video here and I'll link it in the description below. Thanks so much for watching, and I'll see you in the next video for this series.